Today, markets don't fall in straight lines. Hello again, it's Martin North from Digital Finance Analytics, where that is post covering finance and problem news with a distinctively Australian flavour. As I suggested in recent posts, the markets are in a volatile frame of mind, and this won't change quickly as the fundamentals are shifting under us. But I still hold the view that the stock market is vulnerable to a big sell-off once liquidity is withdrawn and interest rates rise. And yet, despite some obvious wobbles, central banks have ensured money has stayed plentiful for the last decade. They cut interest rates, and as a result, anyone who did much to protect themselves against the risk of decline would have done very badly by it. And yet on the other side, the bulls still argue that the environment remains set fair for stocks, and that even a fall in bonds would simply underline the fact that there is no alternative to equities. And of course, they have been right for the best part of a decade, and they will be until they're not. When stocks reach a true bubble and valuations go far above the long-term trends, they tend to go into a blow-off phase at the top. Jeremy Grantham, the founder of GMO in Boston, reaffirmed recently his aggressive call from last year that US stocks have indeed entered a bubble. Using cyclical earnings multiples, he shows that previous bubbles have seen blow-off tops, and this looks like another. Grantham's models for price-earnings multiples is based on the return on equity or profitability of stocks and the volatility of inflation and of economic growth. When inflation is higher, investors should demand a lower earnings multiple to combat that inflation. And in fact, since 1925, GMO's model has worked beautifully. It's only gone wrong twice, in 2000 at the top of the internet mania, and now. Current levels of inflation volatility are mightily difficult to reconcile with stocks at such expensive valuations. But if you'd looked at the US markets an hour or two before close, you'd say the markets were continuing their linear falls. Yet these kinds of sudden widespread losses day after day, week after week, are actually screaming for a bounce, and we got one. Stocks rose on Monday, with the Dow Jones Industrial Average easing a loss of around 1,115 points to end up in positive territory. The Dow was up 0.29%, ending near 34,365, after dropping 3.3% at its session's low. The S&P 500 finished up 0.28%, near 4,410, after declining 4% at its session low, and the Nasdaq shut up 0.63% at around 13,855 after erasing a drop of 4.9%. Now that is a stock market turnaround. And by the way, cryptocurrencies were initially deeper into the red before rebounding too. Bitcoin, the leading digital asset, was trading above $43,000 last Thursday, according to data from CoinDesk, has since fallen to below $35,000. It was down almost 4% on Monday before ending the day up 2%. And by the way, it was worse for the smaller peer Ether, which was down almost 8% before it ended the day up 3.7%. Now, whether this will be what traders call a dead cat bounce that then leads to more losses or the beginning of something new, well, we'll have to wait and see. The volatility was driven by fears of tighter monetary policy from the Federal Reserve and also a military conflict in Russia, and frankly simply being on the wrong side of the trade. Of course, investors then bought the dip. But there are a few contextual points to make. The S&P 500 rose 0.3% after falling nearly 4% at one point during the day, but the index is now down 8% from its all-time high set on January 3rd, but has so far avoided closing in correction territory. That means a drop of 10% from a high. Panic, though, was the name of the game, as the drop sent Wall Street's fear index, the volatility index, up as high as 38.94. That's the highest since October 2020, before it pulled back to 29.90. And not to be left out, the Dow Jones Industrial Average rose 101 points, or 0.3%, erasing earlier declines of more than 1,000 points. and it's down some 7% from its all-time high set on January the 4th. While the Nasdaq gained 0.6%, the tech-heavy index fell into correction last week and is now down more than 14% from its recent highs. The biggest gain of the day was in the Russell 2000 index of small-cap stocks, which briefly entered bear territory on Monday before posting a gain of 2%. So, what is causing the falls? Well, first, of course, it's the sense that the Federal Reserve will release its interest rate decision on Wednesday. It is ready, perhaps, to slam the brakes on growth in the US to tame inflation. Traders expect 4 interest rate hikes in 2022, which the Fed would implement to curb inflation and move, of course, that would choke off economic growth. Plus, bond yields have risen this year, partially a response to the Fed ending its bond buying program. That makes future profits less valuable, causing valuations to decline, especially for tech and growth stocks. The primary damage is a compression of valuing the earnings in the face of potentially high interest rates as central banks tighten monetary support to address inflation, wrote Louis Navier, founder of Navier and Associates. That brings the Fed into focus this week. The central bank will make a decision on interest rates. Although markets don't expect a rate hike until March, investors will be watching the bank's statement to see if a March hike is now more or less likely, and whether the Fed will slam on the brakes to slow inflation. That does seem unlikely, says Mizuho economist Alex Pelle. He noted that much of the economic data since the last FOMC meeting had disappointed. It's been even worse recently, with the City Economic Index dropping down 2.9 points, down 22.1, since the Fed ended its quiet period. Overall, we expect markets will be able to breathe a sigh of relief following Powell's post-meeting press conference, Pelle writes. In our view, the risk of a hawkish surprise, one that is not already discounted by markets, is low. Adding to the concerns is the possibility of tensions on the border of Russia and Ukraine, leading to military aggression. The North Atlantic Treaty Organization is sending ships and jet fighters to Eastern Europe in response to Russia's military build-up near Ukraine. The European Union also plans to provide loans and grants totaling more than $1 billion to Ukraine. Investors appear to be concerned about the timing and pace of monetary policy tightening, the persistence of inflation, and potential profit margin pressure, writes Keith Lerner, Chief Market Strategist at Trust Advisory Services. And now we can add building geopolitical tensions surrounding Russia and Ukraine. Still, if Ukraine and Russia were really an issue in the commodity space, crude prices would be falling. Futures contracts for West Texas Intermediate fell 1.3% to under $84 a barrel. So before the market rebounded on Monday, it had started to feel like a stock market bubble had popped. Last week, the 3 major indices suffered their worst week since 2020. The stock market has been concerned about tighter monetary policy. And remember, the S&P 500 had an impressive run-up, 92% from its bear market bottom set in March 2020, as investors had enjoyed a Federal Reserve that was insistent on supporting the economy and markets. After Monday's rebound, that is all up in the air. But my message is simple. Don't get too comfortable yet. At 4,400, the S&P 500 still hasn't risen back to its 200-day moving average. This indicates market participants still aren't fully comfortable buying stocks at prices consistent with their longer-term trends. And we're also going to get more earnings news that may help, remembering that some of the tech results recently, including from Netflix and, by the way, the big banks, were all well below par. And within the next 2 weeks, Apple, Amazon, Microsoft, Alphabet, and Tesla will all report earnings. And if those stocks post large moves in earnings, they could move the S&P 500 and Nasdaq in one direction or the other, as those stocks are worth a combined several trillion dollars together. And as John Authers from Bloomberg put it yesterday, we all face one risk when investing that's greater than perhaps any other. The risk that we are wrong. It's all too easy to be convinced by your own logic and let confirmation bias do the rest. When investing, it's worth having conviction, but it's also necessary to take out some insurance against the possibility of being wrong, even if this dilutes returns. And I think that is very good advice just now, because the level of uncertainty continues to burn away, and frankly, outcomes are just not clear. Now, if you're buying your home in Sydney's contentious market, you don't need to stand alone. This is the time you need to have Edwin Almeida from Ribbon Property Consultants standing alongside you. Buying a property is both challenging and adversarial. The vendor has a professional on their side. Emotions run high, price discovery and price transparency are hard to find, and then there's the wasted time and financial investments that you make. Edwin understands your needs, so why not engage a licensed professional to stand alongside you? With RPC, you know you have experience, knowledge, and master negotiators looking after your best interests. So shoot Ribbon an email at info@ribbonproperty.com.au, and if you use the promo code DFAWTW/Martin, you can get a 10% discount offer. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.